Well, it certainly has been a pretty wild time in the market, and we are here for you in terms of communicating what we know or what we understand at the moment, and that's what I'm here to do as usual on Employment Friday. So normally and today we will start with monetary policy, fiscal policy, economic statistics, what the markets are telling us. And then I'll share with you a little bit about our brainstorm today. We talked a lot about what is going on in the stock market, trying to put all the cross currents together. So, some pretty interesting insights out of that. But first, I've been getting the question, what keeps you awake at night? And I can tell you honestly, the one thing that keeps me up at night is that as the market goes down and our strategy is punished disproportionately, what keeps me up at night is knowing that some people are going to panic if they're looking at their accounts on a day-to-day basis. We keep saying, almost every time I talk, I say we have a 5-year investment time horizon. And at the moment, we are close to, from an expectations point of view, a record in terms of what we expect from our portfolios during the next 5 years at a compound annual rate of return. I've seen it only higher once, and that was after the rout in the fourth quarter of 18. And based on our expectations at that time, we believed that our portfolios would deliver a compound annual rate of return of 42%. So that's 42% over 5 years. That's more than a quintupling. And we're just about there again. So again, ahead of just spectacular growth rates, exponential growth rates associated with the innovation platforms. So DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology. And even more importantly, the convergence between and among those platforms. We believe that our companies, from a revenue growth point of view and ultimately a profit growth point of view, are going to show exponential growth rates. And we would assume, now we may not be right, but we would assume that the stocks would award them or the market would reward them accordingly. So with that said, just let me talk a little bit about FUD, fear, uncertainty, and doubt, in a market when Chairman Powell, Federal Reserve Chairman Powell, sort of changed his mind from inflation is transitory to perhaps it's not transitory. I think that has unnerved the markets, and we've got investors and analysts fleeing back to their benchmarks. Our strategies typically include stocks that are not in the broad-based benchmarks. And so our stocks are the ones they sell in order to move back into the benchmarks. I've been through this time and time and time again. This is no different. And so we usually do the opposite. We know they're throwing our stocks out, and therefore, instead of trying to get close to any benchmark, and as you know, we don't have a benchmark, we're looking to the future, not the past. We concentrate our portfolios towards our highest conviction names and toward those stocks that have been punished disproportionately and we believe unfairly in the marketplace. And just to give you a glimpse of what I mean, our portfolios, our strategies have been associated with stay-at-home stocks because they treated us so well during the coronavirus crisis. But the point we've been trying to make is that the world has changed permanently because of the move towards increased digitalization. We're not going back. And therefore, we think that you should start thinking about these stocks not as stay-at-home stocks, but stay connected stocks, stay competitive stocks. stay globally competitive stocks, because that's what we do. We're focused on the way the world's going to work, and really transformational growth. So with that, let me start with monetary policy. So M2, the growth rate of M2 is 13%, and it's been around that growth rate on a year-over-year basis since June, so five months or so. And that's down from 27% in February. And that is when a lot of turmoil started in the market, because the markets and the algorithms had gotten used to money growth accelerating. And then all of a sudden it was not accelerating anymore. And here we are in the last 7-8 months in a serious correction for high valuation or high multiple stocks. So that was the beginning, and yet the market was reassured from time to time when Chairman Powell said, inflation is transitory. We're facing there's a basis effect comparing against a year ago. We've got supply chain problems we need to work through. And when we get through them, we'll be on the other side, and pricing will fall more into line with that maximum 2% CPI. Right now, we're at a 6.2% on the CPI. That's the headline CPI. The core CPI is closer to 5%, and what the Fed watches, the core PCE deflator, is closer to 4%. But it seems as though Chairman Powell has gotten a little less comfortable with this notion that core rate was going to start to decelerate towards the 2% or less during the next year. So we'll get into that more. Our confidence has increased that inflation is going to unwind, and probably more dramatically than most are thinking right now. So now, as soon as Chairman Powell made the comment that he wasn't so sure that the inflation rate we're seeing today is transitory, the bond market did something very strange. It rallied, and that means interest rates went down. That's a very curious phenomenon in this market. The Fed chairman says inflation might be more of a problem, and the bond market basically says the opposite. So very interesting, and reminiscent of another time when the bond market was right and the stock market, the stock market was wrong. It was really in the 06, early 07 timeframe, where the bond market was warning that the world was slowing down, and we had no idea how much it was going to slow down. But as we all know, it did. The other thing that has happened in here is that the yield curve has started flattening. It actually started flattening soon after money growth rates started decelerating. And in March, the difference between the 10-year government bond yield and the 2-year yield was 160 basis points, or 1.6%. Today, it's down to roughly 75 basis points, or 0.75%. Now, what does that mean? A flattening yield curve typically means that the bond market, bond investors, are fearful of either recession or pleased that inflation is coming down, or both. So it seems to be telegraphing either a recession on the horizon, inflation coming down, or both. And we would submit that we believe the economy will not drop into a recession, but we do believe there's going to be a recession scare next year, and it has to do with inventories.